Let's go see what happens then if you were to basically take an eligible dividend and get paid $50,000. Well, you're only going to be paying $600 in taxes. This very well may be the most important video you ever watch because, whoo, baby, we're talking about Canadian dividend tax loopholes, and to show you how rich people stay rich, virtually pay no tax, and why you can put yourself in that category, because if you don't start now, you're gonna be broke for the rest of your life, baby, and we don't want you to be like that. We want you to join the hashtag rich gang here, like the rest of us, who have actually spent years. I've spent a personal decade now becoming a millionaire between real estate, building a portfolio, talking about TFSA's RRSPs to corporate investing, and I'm kind of accumulating all this knowledge to literally share with you completely for free. So if you're on a path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button, because I'm going to start very simple here, and then we're going to scale into some of the complexities of the Canadian tax code. But first and foremost, when I show you guys my portfolio overview here, this is a combination of basically my corporate investment account, my TFSA, and my RRSP. All of these accounts I'm using for a variety of different tax purposes, and we'll start and explain to you the dead basics, because if you're new to this, you need to get a TFSA. This is an account where you make money, you pay tax on that money, the government lets you put it in this tax sheltered account where you can basically make dividends, capital gains, tax-free in perpetuity for the rest of your life, pull those gains out, and then spend it on whatever you want without it affecting your tax bracket and paying no tax at all. Now, there's limits to how much you can put in these accounts. You can go into the CRA website to find that out. And now on the other spectrum, you have something called an RRSP, a registered retirement savings plan, where essentially when you pay tax on your income and you put it in this account, the government will actually return you the tax. They'll defer it. They'll say, hey, you're putting money in this account, let's defer the tax. We're not going to pay any tax on that money. You're going to be able to earn capital gains and dividends tax-free until you pull it out at a retirement date, or any date really. You can pull it out whenever you want, and whatever amount you pull out will then be taxed at your marginal tax rate. Both these accounts are absolutely beautiful, and I always recommend maxing them first before doing anything else, because that is the pivotal end-all be-all to tax-free income in perpetuity for virtually the rest of your life. So let's get into what happens when you surpass that, because what does it look like in a regular account? Like if you're just investing in stocks through a regular account, and what does it look like when you start investing into a corporate account? In order to understand this, I want to talk about tax brackets first and foremost, and show you how multimillionaires, billionaires can virtually pay no tax, because the idea here is we are in a marginal tax rate, right? So if you're working at a job, you get a salary income, depending on how much you make, the different levels will be taxed at different brackets. So the first $55,867 as of 2024 is only taxed on 15% of that. This is why I'm always annoyed when broke people complain they're paying too much taxes, because if you're making under 100K, you're really not paying at all that much tax. And you can kind of see it by coming into the Wealthsimple tax calculator. So for example, if you made 50,000 bucks, you're going to pay about $10,304, because you're going to be putting some of that into CPP, which the government automatically takes toward your retirement. Provincial tax and federal tax is only going to equate to about $6,500. It's really not all that much, right? So you're going to lose about $10,300. So you make 50, you're going to be left with about 40. But once you start entering that 100K area, that's when anything above that 50K is going to be taxed at these different rates, right? So that's when you're really going to start feeling the pain, because now that 100K is going to be taxed at $26,000, which is substantially higher than the initial amount of the 10 that you would have paid, right? So you're paying about 16 more on top of that 50. I hope that kind of makes sense. You can deep dive into this with this tax calculator as much as you want. But understanding this, let's go see what happens then if you were to basically take an eligible dividend and get paid $50,000. Well, you're only going to be paying $600 in taxes. An eligible dividend is basically a Canadian company, a corporation that makes at least 50% of its income in Canada, and they're basically already being taxed above the small dividend tax deduction rate. So the government says, okay, this Canadian company is already paying tax on this income that they're distributing to shareholders, so we're going to give them an eligible tax credit that literally reduces their taxable income to virtually nothing. So let's say you're going to make 100K. Let's just see what that would look like, because there are limits to how much the government will tax you on these, right? So you're only going to be taxed about $4,000 on 100 grand. I just really want you to let that sink in for a moment, right? Now, let's see how that compares to capital gains, because obviously capital gains and dividends are tax-free in a TFSA, but in a regular account, let's presume after the tax changes as of June 25th, 2024, let's say you're actualizing a capital gain of $50,000. How much are we going to pay? we're only going to pay $2,331. Okay, so let's say it's 100 grand, right? How much are we going to pay on that? Well, we're only going to be paying about $7,643. This really goes to show you why it pays off to be a shareholder. It endlessly reminds me of when Bell Media did that mass amounts of all those layoffs, but I think subsequently literally raised the dividend on the announcement of the layoffs. It's insane to me how shareholders get all these benefits, and why, as you make money, you need to understand this as you scale up in your generational wealth, right? Because once you get past the TFSA and RRSP, you're going to start realizing how things are taxed differently. And sometimes if you want to get growth out of, say, US stocks, you're going to have to be a little bit more cautious, but US stocks and capital gains are taxed the same. But you have to understand that US stocks will, on the dividend side, will not be taxed the same, right? Because unfortunately, ineligible dividends, as we see at a $50,000 level, ends up kind of getting taxed still at a crazy reduced rate, but it's still higher than basically nothing, right? But I really don't want you to be like Canadian biased. So you have to understand that you can invest in US stocks, and you should maybe invest more for capital gains than dividends because they're taxed more efficiently, right? Because the capital gains are the same regardless, where if dividends, you're going to be exposed to a withholding tax plus the higher ineligible dividend tax. So just keep that in mind. It's still all greatly reduced compared to basic salaried income. And in a recent interview I did with the Canadian Finance Pro, we were kind of discussing how sad it is that people that are salaried employees are basically subsidizing the entire economy, and they are the ones that literally are subsidizing the rich as well. It's really insane to me. This is how the whole tax code system works, but we're going one level deeper, which is corporate tax investing and how those dividends can be taxed, because a lot of people do not understand that corporations, first of all, make money, they spend that money, and then they pay tax on whatever's left. You as a salaried employee or on an hourly rate, whatever, you're taxed, you get that money, and then you spend it, and you're also, having to pay HST and some taxes on the stuff you're buying. And obviously corporations still have to pay the tax on the stuff they're buying, but they're not paying any tax on the income, only on what's left over. This is why it's so important to understand what it's like to be a sole proprietor or starting a small business, even if you have a salary job, and you can put some of that money toward things you'd spend on anyways, but could be claimed toward taxable expenses for your business, whether it's some of your food, your lunches, a part of your property, or your rent. All of that can greatly take advantage of what I would call the final boss of basically tax advantaging your lifestyle, right? Because you can get a lot of tax money back by taking the salary income and using it on taxable expenses for your business that might not be profitable today. Now, keep in mind, you can't scam the government. CRA can smell some fishy stuff out if you're just taking advantage. But I promise you, if you're just doing small business, dog walking, social media, all of that can be used toward sole proprietor, small business deductions, et cetera, right? But in the world of corporate investing, you have to understand that on the first $500,000 made in a Canadian business, you are only subjected to the small business income tax, which is like 11.5 to 10% here in Ontario, which is kind of crazy to me. If we take this even deeper now, and there's so much I could spew to you guys. Like, I end up paying my wife out because she helps my business. So I pay her as a private contractor, which is a write-off against the business. She's in a lower income tax bracket, but I'm not paying her enough that she'd have to pay HST. Like, there's so many things you can do here that are just absolutely mind-blowing. But let's take this a step farther and talk about the intercorporate dividend. So how are corporations taxed on, capital gains? How are they taxed on dividends? Because unfortunately, you have to pay attention here because things vary dramatically. Luckily, in a corporation, it's still the capital gains tax is roughly the same still. You pay basically whatever the marginal rates are on 50% of the gains. That could change with new legislation. That could raise it to 63% or 2/3. But keep in mind, that's the marginal rate. You do not pay tax on right now 50% of those capital gains. It's why in my corporation, I mostly invest in the S&P 500 and things that don't pay dividends. But what I'm learning here is if one Canadian corporation pays another Canadian corporation a dividend, you can actually waive 100% of the taxes, because an intercorporate dividend refers to dividends that are paid by one company to another company holding shares in first, particularly where the companies are operated by the same person or group of people. There's a lot of variables that come into play, but we can actually read into the Canadian tax code here that says a corporation may offset its income inclusion by deducting the total of taxable dividends it received from a taxable Canadian corporation or from certain corporations that it controls. So basically, it's taxable dividends that are generally paid tax-free between Canadian corporations. This tax treatment is subject to several anti-avoidance provisions. So basically, if people are doing something nefarious, the government has provisions to try and prevent it. But this is a real reality that Canadian corporations can interpay dividends and not pay any tax, which again is absolutely mind-blowing to me, right? Most people are completely unaware of this, and I'm not recommending you go out and just buy Canadian dividend stocks, but once you've maxed that RRSP, that TFSA, and you're kind of sitting here thinking about like, what's the most tax efficient thing I could possibly do to continue to scale my wealth, it's looking into starting a sole proprietor or a corporate account. You do not need to open a corporate investment account. Just being a sole proprietor and starting a small business can come with massive tax deductions on things you would already be spending money on anyways, like lunches, again, part of your rental unit if you're working out of your house. So much more in between. You can look at spousal, hiring them as a part-time employee to the company, finding other ways to write off things. And then on top of that, you can start using corporate investment accounts, which are absolutely mind-boggling because essentially I use my corporation as a third-party wave of liability because my corporation has looked at it as its own entity. I am just the primary shareholder of the company. So if I personally get sued for something, they can't just go after the corporation, vice versa. Same with marriage. If you love your wife, it's a lot easier to hand her shares of a corporation. With the government won't tax any of it, she can just take over it and then figure out, how to get money out in a tax efficient way. Whereas if, you don't like your wife or something like that, she can't just come after your corporate money. She's not entitled here in Canada to your corporate money. Maybe it's some different in some of the states. But yeah, and then on top of that too, right? Like if you die and you're going to leave your parents, your wife, family money in a regular account, it gets kind of tax inefficient because the government will probably tax some of that. But again, in corporate account, they can't take any of it. There's so much convoluted things that come into play here. But if you guys want to continue this conversation, let me know what you think in that comment section below.